What if I told you that the secret to one of the world's greatest investing fortunes isn't some black box algorithm, but just a handful of timeless, simple ideas? For decades, people have tried to crack the Warren Buffett code, but they keep missing the point. They're searching for a complex formula when the real strategy has been hiding in plain sight all along. We're going to break down the powerful back-to-basics philosophy that guided his legendary bets on companies like Coca-Cola and Apple, and show you how that same logic can apply to your own financial life. Section 1. The secret is a mindset, not a formula. Here's the biggest thing people get wrong about Warren Buffett. They think he's a stock picker. He's not. He's a business picker. The very first rule of his strategy is to think like you're buying the whole company, not just a ticker symbol that zigs and zags on a screen. This means he never ever invests in something he doesn't fully understand. He calls this his circle of competence, and it's the reason he famously sat out the dot-com bubble. His rule is simple. If you can't explain what a company does and why it will still be making money in 20 years, you have no business owning it. This way of thinking is all about the long game. Buffett once said, "Our favorite holding period is forever." He couldn't care less about daily market noise or what some analyst thinks about next quarter's earnings. He is laser-focused on one thing: a company's real underlying value based on its health and ability to earn money far into the future. It transforms investing from a slot machine into a disciplined business decision. Section 2. The Coca-Cola Masterclass. Value in plain sight. There's no better case study for this than his investment in Coca-Cola. Picture this. It's right after the stock market crash of 1987. Fear is everywhere. But where everyone else saw panic, Buffett saw a bargain. He looked right past the short-term chaos and focused on the undeniable, timeless value of the business. Coca-Cola had what he famously calls an economic moat, a powerful, durable advantage that competitors just can't touch. For Coke, that moat was its legendary global brand, a name recognized and loved by billions. The business itself was beautifully simple: make a product people love and sell it everywhere. While others fretted over the stock price, Buffett saw a wonderful business selling at a fair price. Between 1988 and 1989, he invested about $1.3 billion. Today, that stake is worth over $25 billion. But here's the truly mind-blowing part. Berkshire Hathaway now receives over $700 million in dividends from Coca-Cola every year. That means he gets back more than half of his entire original investment every single year just in dividends. This one trade is a masterclass in his famous advice to be fearful when others are greedy and to hold for the long haul. Section 3. The Apple Bet. Applying old rules to a new giant. For years, critics claimed Buffett's refusal to invest in tech was a major blind spot. Then, in 2016, he made a massive bet on Apple, proving his principles are timeless, not outdated. So why Apple? Because Buffett didn't see it as a complicated tech company. He saw it as a consumer products company with one of the stickiest ecosystems ever built. The incredible brand loyalty and the way customers are locked into its world of devices and services create a monster of an economic moat. On top of that, Apple was a cash-generating powerhouse that was constantly buying back its own stock. Buffett loves buybacks because it means Berkshire's slice of the apple pie gets bigger and bigger automatically, without him spending another dime. That bet grew from an initial cost of about $36 billion into Berkshire's largest single holding, at times valued at over $170 billion. The Apple investment is perfect proof that Buffett's philosophy isn't about avoiding certain industries. It's about patiently waiting for an amazing business to become available at the right price. So, what is Warren Buffett's big secret? It's not a secret at all. It's the disciplined, patient and relentless application of a few core ideas. Buy businesses you can actually understand and that have a durable competitive advantage. Wait for a price that gives you a margin of safety, a discount that protects you when you're wrong, and most importantly, have the guts and patience to hold on for the long run and let compounding do the heavy lifting for you. As Buffett famously says, price is what you pay, value is what you get. These ideas aren't complicated, but they demand discipline. By focusing on real value and thinking like a business owner, you can build a stronger financial future. If this breakdown helped you, make sure to subscribe and hit that notification bell for more deep dives into the minds of the world's greatest investors. This is Growth Minded. Thanks for watching.